Hi everyone, welcome to the second virtual finance workshop. Our first meeting last week was really great, so we are grateful to Daryl for the great talk. We also thank all the participants for being here. And now before we move on to our second talk, let me review a little bit the format. The presenter, Ralph Koijen, will speak for 50 minutes uninterrupted, and then it is going to be followed by a 25-minute Q&A session. If you would like to ask a question, you can do three things. One is that you can submit the question during the talk by clicking on Q&A, which should be there at the bottom of your Zoom screen. Or at the end of Ralph's talk, you can use Zoom's raise hand feature to indicate that you would like to ask a question. And finally, you can also submit comments during the talk through the chat. The trick is that only us, the panelists, receive your comments, but we will forward them to all the participants. And please note that we will only filter comments because of Zoom bombing. So please definitely feel free posting comments. And then I want to point out that since there are so many participants, it's unfortunately very unlikely that we can take all questions or comments live during the Q&A session. So we thank you all in advance for being understanding of this. And after the seminar is over, the speaker will have access to questions and comments that we did not get to raise and address during the Q&A session. And now, without further ado, let me turn this over to our second speaker, Ralph Koijen from Chicago booth, who will present his paper, Coronavirus Impact on Stock Prices and Growth Expectations. Ralph, please.
Okay, well, thank you so much for inviting us to present this. I hope everyone is doing well given these unprecedented circumstances. So this is joint work with my colleague at Chicago, Niels Gormsen, and obviously, given the topic, this is very recent, and so any comments, suggestions, or feedback that you may have would be really helpful to us at this point. So the motivation is okay. So the motivation for this is obviously in trying to understand sort of what the outbreak of the coronavirus, for which at this point there's no treatment available, for which there's no vaccine available, what we can say about sort of the path of future economic activity going forward. And so it's motivated by the policies that were triggered by the virus, like social distancing, like the lockdowns that we've seen in various countries, and really what is the impact of like pausing the economy on firms, on households, and ultimately also the financial sector and governments. And so one approach may be to use models based on macroeconomic data, but those may be relatively slow to update, just given the speed with which macroeconomic data becomes available. And in some cases, they may even get a sign wrong in the very short run. For instance, if you see stockpiling in certain areas, then you actually may see that sales goes up, even though we're sort of expecting a very sharp slowdown. And so it seems natural to turn to asset prices like equity markets, government bonds, corporate bonds, as those are forward-looking and may tell us something about investors' expectations. Okay, and so that's what we're going to try to do in this paper. Now, if you look at the stock and bond markets in the US and in Europe, then the pattern is quite striking. So the top left, you see the stock returns, cumulative stock returns on the S&P 500. The top right is the Euro Stoxx 50 index. The bottom left is the cumulative return on 30-year US treasuries, and the bottom right are 30-year German government bonds. And so what you see is that initially, during the outbreak in China, there's not much of a movement in the stock markets in the US and Europe. But then following the spread to Europe and subsequently to the US, you see that stock markets decline very sharply. And so this has received a lot of attention from policymakers and market participants. And oftentimes people like point to the stock market to suggest that a very sharp recession is around the corner. Now, for stock markets to fall so much just because of fundamentals, that seems quite extreme in the following sense. So stock markets, they fall by as much as 30%, and bonds rally by about the same amount. And so if you think that this is just driven by fundamentals, then if you would add up just the first 10 years of dividends that are paid out by either firms in the S&P or the Eurostoxx index, then those make up just 20% of the value of the stock market. So what that means is that suppose that corporate America would not pay out any dividends over the next 10 years, then then dividends jump back up to where they were before the crisis, then you would imagine that the decline, or then you would see a decline in the stock market of just 20%. Now we know since the seminal work by Shiller and Campbell and Shiller and Cochrane and many others that we shouldn't sort of think of of these movements in the stock markets as just reflecting fundamentals. So we know that most of the variation in stock markets are due to variation in discount rates, I don't know, perhaps related to risk aversion, to sentiment, to uncertainty or institutional frictions. And for that reason, we shouldn't sort of be too worried about what it tells us about future economic growth. Now, the downside, of course, is that means that we can't learn too much, perhaps, from just staring at the stock market about the path of economic growth in the years to come. And so what we're going to do in this paper is we're going to decompose the decline in the stock market by maturity. And so the basic idea is the following, that if we think of like ST as the value of the stock market, then the value of the market is equal to the present value of all future dividends. So we have in the numerator over here the expected dividend in n years from now. And in the denominator, we have the maturity specific discount rate that applies to that cash flow. And so we don't have powers here. Think of this as just a cumulative discount rate that applies to that cash flow. And so we can now start thinking about like breaking up this entire claim to all future dividends by maturity. And so we're going to refer to PTN as the price of an n-period dividend strip. And so what an n-period dividend strip does is that it gives you a claim to the dividends that are being paid out by firms in the S&P 500 or the Eurostoxx index in one particular year. So let's say in 1 year from now or 2 years from now. And so these dividend strips are very similar to government bonds, but instead of paying you, let's say $100 at maturity, it's going to pay you the dividend just in that 1 year. And so that means that we can break down the decline in the market as a whole. We can break it down by maturity and see what we can learn from that to interpret the movements in stock markets and think about asset prices more broadly. Now, if we add up these dividend strip prices across all the maturities, they're going to add back up to the market. Okay, so that's sort of this equation here at the bottom, so that the market as a whole is effectively a portfolio of dividend strips with all the maturities from now until infinity. And so what we observe in the data, using data from dividend futures markets, that I'll tell you about in a little bit, is we effectively observe these dividend strip prices for the first 10 years. Okay, and so we're going to sort of think about what we can learn from those prices. Now, why could they potentially be informative compared to the market as a whole is that the short-term dividend claims, and this goes back to an argument by Brennan in the late 90s, is that if you think about the claim to, let's say, 1 year dividend, so the contract that's going to pay out at the end of this year, then if that price would deviate a lot from fundamentals, then it will be fairly easy for investors to come in, let's say that the price drops too much, to buy the 1 year claim and to wait out for December and actually receive the fundamental. And so it's a very close connection where you can directly sort of like speculate on the fundamental by a given maturity and hold the position for, let's say, just 1 year. While the market as a whole is, of course, also impacted by the resale value and long swings in risk aversion or sentiment or uncertainty may add additional uncertainty that you do not have with these short-term claims. And so in that sense, these may be closer tied to fundamentals. Okay, so what do we do? The first part is simply just data description. We're just going to tell you what the dynamics of stock markets and dividend futures look like during this episode. So we're going to look at some of the key days and weeks where the market moves a lot. And it's going to give us we think, like sort of an interesting narrative in understanding like how prices move in response to some of these shocks. Then we're going to use dividend futures to study the evolution of dividend and GDP growth expectations. And we're going to sort of provide two measures of expectation. So one is a lower bound that we can directly compute in the data without further sort of modeling. And it's going to rely on a fairly weak economic assumption that we think is quite plausible to be satisfied during this episode. An alternative ways to really try to provide the best forecast for dividend and GDP growth, and not a lower bound on the expectations. And there we do require additional modeling assumptions. But the broader point that the first two parts of the presentation hopefully will make is that even though there's a lot of attention to what happens in stock markets and credit markets, there's not a whole lot of discussion of what we can learn from dividend futures markets, and we think that these data are quite informative to study alongside these other markets. Now, the third part, we're going to write down a very simple model to sort of organize our thoughts in terms of which shocks are actually priced and what are the risks that investors may be worrying about. And that model is going to serve several purposes. One of them, for instance, being that it's going to give us another way to figure out growth expectations in a slightly more structural way. And in addition, there are structural parameters in the model that are of broader interest also in macro finance models, such as the economic cost of social distancing. So to this part, I should mention is already it's sort of much more in progress, but you'll see where we're going with that. Okay, so just a very brief link to related literature. So obviously, we're building on sort of the recent literature on dividend pricing across maturities. An early paper on this is by Brennan that I just mentioned, who suggested that if we were to have these data, because back then these data didn't exist, then it would be quite informative to learn about fundamentals by maturity, and sort of we're following that suggestion effectively. So then there's been work by Letta and Walker and Hansen, Heaton, and Lee, and try to understand both theoretically and try to estimate sort of how risks are priced across maturities. And then sort of the first papers that directly measure dividend prices is the work that I've done with Jules van Binsbergen and various co-authors, where we either use data on option prices or dividend futures directly to think about asset pricing properties. But we also showed in the second paper with Wouter Huiskens and Evert Vught that these dividend futures prices are informative about future growth. And then Niels in his job market paper thought carefully about how risk premia move across maturities during good and bad times. Now, of course, there's a massive literature that I'm not going to be able to do justice to in this talk, that thinks about asset pricing growth expectations for equities, government bonds, and corporate bonds, and many of you have thought about these issues. Now then there's two recent sort of literatures that jumped up in response to this pandemic. So one is a more a literature that tries to think about sort of macro models featuring pandemics. Now those models are going to have some connection to what we're writing down in the asset pricing model. But of course, a key feature that we need to introduce that is not in those models is uncertainty, because we want to think about asset pricing, we want to think about risks, and a lot of the models are deterministic. Now, of course, there's also a lot of interesting sort of very recent work trying to understand growth consequences, either using data going back to the earlier pandemic in the early 1900s, or very recent, or using very recent data as well. Now, in parallel, there's also literature on asset prices and the current crisis already, and so the broad themes that emerge is to see what we can learn either from the cross-section of firms, industries, or countries about how investors are pricing this. And so our sort of unique feature here is to think about the pricing across maturities and focus on growth expectations as well. Okay, so just to clarify what the data is that we have and how it links to the earlier prices that I mentioned. So remember that PTN, that is the price of a claim to end-year dividends. If we scale it by the current level of dividends, DT over here, then the price is equal to the current level of dividends times the expected growth rate, cumulative growth rate over n years, and then discounting that back to today with the maturity-specific discount rate, mu TN. Now, what we observe in the data is not BTN, but we actually observe dividend futures prices. But those are linked to the spot price through the standard arbitrage relationship. And it means that the futures price is equal to the current level of dividends, and then you get a growth expectation over n years, discounted back now with like 1 plus theta, which is the dividend risk premium. It is the discount rate that we had before, the cumulative discount rate, adjusted for the risk-free rate of discounting. And so the data that we directly have available in markets now are dividend futures that are differentiated by maturity, that tell us something about expected growth by maturity, and the dividend risk premium by maturity as well. Okay, and so we can try to sort of understand the movements in those prices alongside the equity market itself. Okay, so what are the data that we use here? So we're going to use dividend futures data, which are now exchange-traded products. In the US, they're traded at the CME, but also largely over the counter. In Europe, much more is traded on exchanges, and they trade on the Eurex. These contracts, they expire in December, so you get the dividends that are being paid out by firms in that given year, and in December you get that payout. In order to get a constant maturity curve, much like we typically do for government bonds, we're going to interpolate the log prices so that we get constant maturity prices that we can use. Now in the US, we use mid quotes at the end of the day as our pricing data. And in Europe, we're going to use settlement prices, which is the volume-weighted average price during the day. Okay, so the first thing that we're going to do is sort of summarize some of the key events and walk you through what happens to the prices during those specific periods. So just to remind everyone, like some of the key events that as they unfold. So early on in January, or in the middle of January, there's the outbreak and lockdowns in China. Then in February, early March, the virus spreads globally, with Italy, Iran, and South Korea being particularly hard hit. Then you see a response by governments in Europe with partial lockdowns, and the US limits travel from the EU on March 11th. Then on March 12th, you see a very sharp response in the US stock market. Then you see that the US declares the national emergency, but it's late in the day, so European markets are closed, so we can't see anything there. But stock prices in the US, they jump up in the last couple of hours of trading. However, that's only like a short revival, because then in the next week, stock markets fall by large amounts, both in the US and in Europe. Until sort of like the period of around March 25th, where Congress gets close to approving the stimulus package, and you see markets start to rally from there onwards. And so we're going to sort of show you side by side the dynamics in the stock market and in dividend futures markets, and that hopefully is informative about how to interpret market movements. So I'm going to show you four graphs that have exactly the same structure. So then in the right panel, you see the stock market. The blue line corresponds to the S&P 500. The red line to the Eurostoxx 50 index. In the left panel, you see the return on dividend futures, the cumulative return on dividend futures, differentiated by maturity. And so this graph is really like what started the conversation between Niels and me about like what was going on, because initially the market was falling over here from 1.05, the highest level over here, to something like 90 to 95%, which means that the market fell by something like 10-15%, and you see similar, slightly larger magnitudes in Europe. And so if you would interpret this as a shock to fundamentals, then what you would expect to see, given the economic shock that we're studying here, which is a virus which is triggering lockdowns, which is a sort of a very extreme slowdown in economic activity like right now, then it seems sort of like plausible that the short-term economic decline is way larger than the long-run effects. That's not to say that the long run effects are small, but sort of like most forecasts, pretty much all forecasts, predict like a really sharp contraction in the next quarter, next 2 quarters, and then like growth is going to come back at some rate. So you would imagine that if the decline in the stock market during this period was really reflective of investors pricing in a really sharp, deep recession, you would imagine that short-term dividend prices would fall very sharply relative to long-term prices. Well, that's not what we see. So short-term prices actually hardly move during that period, but what is moving are actually the long-term prices. And so that seems much more sort of like consistent with an interpretation that either like uncertainty like picks up or risk aversion increases, and it's long-term discount rates that increase and lead to the decline in the stock market. Now, you may be tempted to say that short-term dividend prices generally don't move that much. That's not quite true if you fast forward 2 weeks, because then you see that the stock market falls by another 20% pretty much. And even more in Europe. And now you see that short-term dividend prices fall very sharply. So you see that the 1-year claim drops by 20% or 30% in Europe, and even more so for the 2nd-year claim. Now, one reason why the 2nd-year claim falls more than the 1-year claim is because we already sort of like have seen some of the dividends being paid out, and there's some anticipation of dividends being paid out sort of in the near future. And so there you see that short-term dividend prices do respond very sharply and more so than long-run prices. And that is consistent with this idea that now at this point, the large decline over here is reflective of a very sharp decline in economic activity in the near term, and perhaps uncertainty about the recovery that follows thereafter. Now, if we then sort of like go to the fiscal stimulus plan that was announced, then you see markets jump up very sharply. But interestingly, it's actually not the short-term dividend prices that jump up. If anything, they actually fall a little bit further. So it doesn't seem to be the case that investors perceive that particular event or that policy as being very helpful to mitigate the drop in economic activity in the near term. But the long end of the dividend prices, they actually jump up. Okay, and so one interpretation of that could be that that investors consider it to be less likely that the current like short-term recession is going to escalate into something much worse, like a financial crisis. And the fiscal stimulus plans are helpful in, for instance, maintaining ties between firms and employees, and to just make sure that as we sort of like put the economy in the refrigerator, that we can also like take it out and it being in decent shape. And so another version of this, of course, could be that it signals that the government is willing to step in more aggressively than anticipated before, or get stuff done more efficiently than thought before, and risk aversion or uncertainty declines. But so the interesting observation here, we think, is that short-term prices hardly move, or if anything, they fall, while the long-term prices move quite sharply. If we then go to the recent period until last week, when we last updated our data, you see there's a bit of a recovery in the US on the short end. In Europe, not so much. But again, it's like largely moving in long-term prices. Okay, and so it sort of tells you a narrative where the initial decline is not sort of like very visible in short-term dividend prices. The second period is characterized by a sharp decline in short-term dividend prices as well as long-term prices. The recovery following the fiscal stimulus plan is entirely in long-term prices, and short-term prices, if anything, they drop. And then the sort of the current recovery is sort of a mix of like both short-term and long-term prices, at least in the US. Okay, so how do we go from here to growth expectations? So we're going to derive a lower bound on growth expectations under, we think, economically reasonable assumptions that will only depend on the data we can observe directly. And then we're going to sort of like do another exercise to sort of try to forecast growth in the best way we can. Okay, so the idea here is that we're going to look at the change in the percent change in dividend futures prices. Okay, so that's on the left-hand side over here. And that one is equal to the percent change in growth expectations relative to the percent change in discount rates. And the assumption that we're going to make is that discount rates, investors' expected excess returns, did not go down during this period. So that means that investors' risk aversion or uncertainty did not go down, and our sort of like interpretations or intuition is that during this period, risk aversion went up, uncertainty went up, and as a result, the denominator over here increased. Under that assumption, we can get a lower bound on growth expectations by maturity, simply based on looking at the percent change in dividend futures prices. Okay? And the right-hand side only depends on market prices. So if we look at that lower bound at this point, then this is what you get. So 1 year out, the lower bound for the S&P 500 is minus 20%. For Europe, it's quite a bit more negative at almost minus 50%. And then you see a recovery that follows thereafter. Now, given that this is a lower bound, it's sort of an interesting question to ask, like, well, how tight is this lower bound? And in particular, during sort of like extreme downturns. And so we go back to 2008 and do exactly the same calculation. And so what you see over here is that the yellow dashed line in both figures, so the right figure is for Europe and the left figure is for the US. The yellow dashed lines are exactly the same as the one we had in the previous figure. The blue line over here, those are the lower bounds that we had standing in July 2008. Okay, so that's sort of standing like before the financial crisis. And so what is quite remarkable is that sort of the declines that you see are quite similar in the US at least, and it's a bit sharper in Europe in the short end compared to what we saw in 2008. Now, if we then look at actual dividends that realized, and here we're comparing it to a path of growth, average growth, compared to what you would have estimated before the crisis, then you see that for the first couple of years in the US, up to let's say 3 years, it follows these dividend prices like quite closely. So even though it's a lower bound, it seems to be that, at least based, I don't know, just one observation, but an important observation, these dividend futures prices are quite accurate forecasts of the actual path of dividends. If you look in Europe, then again it follows it quite closely, but you have to keep in mind here that that this event a couple of years out is potentially impacted by the European sovereign debt crisis that happened in 2011, 2012. So the bottom line is that we can directly get a lower bound on dividend growth expectations that at least during the previous crisis gives a reasonably good forecast of the path of dividend realizations in the next couple of years. Okay. Now, one question you may have, given that we look at some of these events, is what about the liquidity of these dividend futures markets? And that's something that has come up in this literature. And so, even though, so in the US it's harder to do, given the fact that quite a bit of the trading takes place in over-the-counter markets, we can make some progress in the euro for the European markets. And so I'm just going to give you the statistics that we can get from exchange-traded products. And so what you see over here in the blue graph is the trading volume from, as reported by Goldman Sachs, on dividend futures. And so what you see is that the volume actually spiked on these contracts. And at the peak over here, the trading volume is 1.3 billion euros a day. So these contracts trade quite frequently within the day. Now, if you look at open interest, order of magnitude, again, you see that this market has been developing, and it's increasing in terms of open interest and in terms of volume. And the open interest for the Eurex contracts, for the Eurostoxx contracts, is order of magnitude at 20 billion now. The global dividend futures market is probably like 2.5 times as large as this number. And so that suggests that these markets have become more liquid, and we already know that these prices gave a good forecast in the earlier crisis where these markets were substantially smaller. And then the last thing that I would like to mention is the bid-ask spreads that we can measure here within the day easily. And so here's just a snapshot that we took, and we're going to do this more systematically using new data that we're acquiring. What you see over here is the spreads on these contracts. So in the different rows, you see the contracts that differ in terms of their maturities. And here you just see an idea of like what the order of magnitude looks like for these bid-ask spreads. So the liquidity and volume tends to be higher for shorter maturity contracts, which is precisely given the current environment that we're in, and we're so interested in what happens in growth over the next like 1 to 3 years. That's exactly where we want to have like accurate prices. And you see that that we think these prices are quite indicative at the short end. Okay, so then what about the mapping from dividends to GDP? So here we need to do a little bit more work. So in our earlier work with Niels van Minsbergen, we already showed that dividends and GDP and consumption, in terms of their cyclical components, are quite strongly correlated. We're going to zoom into that result sort of like a little bit more, and in particular during downturns, which is relevant for what we're interested in here. So just to illustrate that, what we're going to do is we're going to extract the cyclical component of log real dividends and log real GDP using the Hamilton 2018 filter, which is an alternative to Hardy-Prescott. And so what we do is we regress log real dividends or log real GDP on 8 to 11 lags. And then we're going to take the residual as being the cyclical component. So the intuition behind this regression is that you're kind of like standing like 8 quarters ago, like 2 years ago, and you try to forecast where you think log GDP or log dividends will go. Any deviation from that prediction is what the cyclical component picks up. So if we do that exercise, then the time series correlation from 1985 to now is 56%. Now, if you look at these two lines, though, where the dotted line or the dashed line are dividends, and the solid red line is GDP, then you see that during downturns, these lines correlate very strongly. While during normal times or good times, you see there's like quite a bit of independent variation in corporate payout policy and other components of dividends. And so you'll see that like later on in the way we're going to set up the empirical exercise, we're going to focus in particular on downturns. One, because that's what we care about, and two, the dynamic seems to be slightly different during those periods compared to good times. The other thing to note is that the timing is sometimes slightly off. So in 2008, during the global financial crisis, you see that GDP falls first and followed by dividends. The earlier two recessions kind of like go slightly in the opposite direction. So again, in our empirical strategy, we're going to think about how to deal with these slight timing issues that can have an impact on our estimates. Okay, and I think that's really the point where there's a lot of like opportunities for new work to be done to explore how to best map dividend dynamics to other measures of economic growth like GDP, like unemployment that we may care about. Okay, so how do we derive a lower bound for GDP growth expectations? So we saw the lower bound for dividend growth expectations before, and so that one is here on the right-hand side. And so we're deriving a lower bound by scaling up that number with a country-specific coefficient BI. Now that BI, that country-specific coefficient, if that one is larger, given the fact that the term in parentheses over here is negative, if BI is larger, that means that the lower bound becomes more conservative. And so what we're going to do is we're going to run a regression of dividend growth on GDP growth. And then this coefficient BI is 1 over the slope coefficient that we estimate in that regression. The reason that we set it up in this particular way, and we tried like a variety of different ways, the reason we set it up in this way is that any independent variation that you have in GDP growth, delta Y, that is not in dividends, it's going to lead to a lower slope coefficient, A1I. A lower slope coefficient is going to lead to a higher estimate of BI, and that means that our lower bound is more conservative. And so for that reason, across the different specifications that we thought were reasonable that we tried, we chose the one that gives us the lowest lower bound, just to be conservative. And again, like you can sort of think about future work exploring other ways of linking the two to get to the most accurate lower bound one can imagine. Okay, so we're going to have that for the US. This estimate is 0.67. For Europe, it's 0.33. Where one has to keep in mind that the sample that we can use for the US is longer, and so for that reason, these estimates could be slightly different. There's some other conditions that we need, some formal conditions that we need for this to be a valid lower bound that we derive in the paper. Okay, so if you do this exercise, then given the fact that this coefficient BI for the US, let me go back to the previous slide, is substantially larger than for the EU, what you get is that the lower bound over here for the US is also slightly lower as a result. Okay, and so you see that the lower bound on GDP growth over the next year is -15 and -20%, and then things slightly improve. Okay, and again, this is a lower bound on GDP growth. Now, what about actual GDP growth expectations? So here what we're going to do is, and that relates to the earlier work that we've done on equity yields, we're going to use the equity yields to forecast dividend growth. And so equity yields are the current level of dividends relative to the dividend futures price. You take logs and you normalize it by the maturity. And what we do is we then run a forecasting regression for both the US and Europe. And to get power, because it's a relatively short sample, we're going to run a pooled regression where the slope coefficient is the same, but we have country fixed effects to account for differences in average growth rates of dividends. And so we run a forecasting regression of 2 years, the 2-year equity yield for dividend growth over the next year. Okay, and we use quarterly data to do so, quarterly 1-year growth rates. Now, again, consistent with what has been shown in earlier literature and what we sort of like update over here is that the R-squared of this forecasting regression is high. So it's 65%. So dividend growth over the next year is highly predictive using equity yields. Okay, and given that there's a strong link between GDP growth and dividend growth, in particular during bad times, we can sort of use this to forecast GDP growth. Now, we're going to take 2 additional steps to make that mapping from GDP growth to dividend growth. Sorry, from dividend growth expectations to GDP growth expectations. So what we do is we run a regression of GDP growth on dividend growth. The 2 changes that we make is that, first of all, we're going to focus on 2-year growth rates. The reason to focus on 2-year growth rates is that there's these small sort of non-synchronous movements when dividends fall first or GDP falls first. And by taking a slightly longer window, we're picking up more of that movement. The second thing that we do is we only use those observations where dividend growth is below the average dividend growth. And it means that we're going to focus on economic downturns where, first of all, the co-movement is stronger, and second of all, that's most representative of the current situation. So if you do that exercise, you get a slope coefficient of 0.22. With that one in hand, we can form a growth forecast of GDP by taking our dividend growth forecast over here. So this is what we got from the forecasting model on the previous slide, scaled up or scaled down by B2 over here, the regression coefficient we estimated over there. Okay, and so we're using using a downside beta over like a 2-year growth for a 2-year growth rate to deal with like some of the issues that I highlighted on linking the GDP to dividends. Okay, and so obviously these forecasts, like any forecasting model at this point, they come with like lots of caveats in the sense that these are like unprecedented times, and so obviously these historical relationships, they may change, and so of course there's uncertainty around these estimates, but we still think that this is a useful and interesting exercise. Okay, so what we get over here then is on the left panel you see dividend growth expectations, the right panel GDP growth expectations. Okay, and so the blue line again is the US, the red one is Europe. And so you see that the short-term dividend growth expectations, they drop all the way to like -30% at the bottom in the US and -40% in Europe, and then they recover in the recent weeks. And for GDP growth, the decline is -4% in the US, but again, it came up rapidly from an earlier estimate of -6%. The forecast for Europe is substantially lower again at -9%, and it climbed up to -6% in recent weeks. And these estimates are of similar order of magnitude as some of the other sort of industry estimates that have come out, but then this is entirely based on market prices. Okay, so for the last part of the paper, what we want to do is to try to give you sort of a simple asset pricing model to connect 2 parts that now may sort of seem sort of disconnected, which is a lot of the discussion that I talked about in last slides is about dividend futures, and it doesn't make a connection to the market as a whole. But of course, the 2 have to add up, because if you buy all the dividend strips, then mechanically they add up to the market. So to see how these things sort of connect to one another, what we do is we fit a simple Nelson-Siegel pricing model that is typically used for bond prices, but now we use it to price dividend futures prices. And then we can use it to make sure that the model simultaneously prices the dividend strips alongside the market. And so if you look at some of these key dates that I highlighted in the beginning, then what you see from the period from February 20 to March 5th, that was the moment where the market fell, but short-term dividend prices like barely moved. And so that means that this is really a movement in long-term dividend prices. Once the crisis escalates, you see that short-term and long-term dividend prices both fall. And so we want to have a model that is able to sort of like give an economic interpretation to these events. Okay, and so this is, again, this is very much in progress, but you'll see where we're going with this. So what we want from the model is that, first of all, clarify the nature of the shocks and risk prices to explain the dynamics in futures markets and the market and the aggregate stock market. The second thing we want is that we want to uncover some of the structural parameters, such as the economic cost of social distancing, which is sort of like of wider interest than just asset pricing. And also, once we specify the model, we are going to have like a pricing kernel and risk prices. And so it's going to give us another more structural way to go back from prices to actual expectations of growth. Now, what are the facts that we want the model to match? First, initial episode is that there's a modest there's modest news about short-term cash flows that leads to a large decline in the market, but not so much on short-term dividend prices. Then there's a period where the crisis escalates and both long and short-term prices go down. And then the third one is that news about fiscal policy doesn't do much for short-term cash flows, but it really lifts long-term prices. And so those are the facts that we want to make sense of. So the way the model is going to work is going to be like, think of it like 3 phases. So time is discrete, counting 0, 1, and so on. At time 0, investors do not anticipate the pandemic. Okay, so this is not a model where there's some factor that's going to be around like forever. So this is not a model that suggests that we should start finding factors that are priced in the 80s and 90s in the cross-section of stock returns related to pandemics. So this is really a model where there's a new shock that comes along, and investors are sort of trying to figure out how to price it. So time 0, no one anticipates the pandemic. From time 1 up to time tau minus 1. The pandemic develops, and there's going to be all kinds of social distancing measures that are being put in place that are used to flatten the pandemic curve. Now, that's where the first source of uncertainty comes in. So investors gradually learn about the economic cost of pausing the economy. Okay, so that's the first set of shocks that are being priced. Then at time t equals tau, investors learn about the broader damage done to firms and to financial institutions. So firms may start defaulting, they may generate like losses on part of banks and insurance companies. They may then get into trouble, and so the recession may escalate into a full-on financial crisis. And so the second source of uncertainty is the possibility that the deep recession escalates into a financial crisis. And then the third set of shocks that we add to the model are that during the recession, there's government policies, both monetary and fiscal policy, that are being put in place. And what those policies really try to do is to lower the disaster probability in our view. So it's really the idea that it doesn't do much to the short-term dynamics of cash flows, but really what it does is that it makes sure that some of these potentially valuable links between firms and employees, that those stay in place, that the financial sector doesn't weaken too much. And as a result, as the pandemic settles, we can restart the economy in a safe and fast way. Now, I want to highlight that so the places where we sort of introduce sort of uncertainty and shocks, one could sort of make other reasonable choices, I think. And so one of them in particular is that we're going to assume that investors know the parameters of the pandemic model. And obviously that's a strong assumption. And one could easily imagine another version of this model where you introduce uncertainty around those parameters as well. And we think that's interesting to explore. So the first part of the model is the standard model of pandemics, now the SIR model that many of us have looked at and played around with, perhaps even. So the basic idea is that there's 3 groups of people, susceptible, infected, and resistant in this model. And so the susceptible people in this period is equal to the fraction of people that were susceptible last period minus those that get infected. Then the people that get infected at a rate gamma, they move to the resistant group, and then of course we add the new group of people that got infected. Now the rate of transmission, beta t over here, that's going to be impacted by social distancing, which we just normalize to be between 0, 0, and 1. So social distancing can mitigate the rate of the spread. We're then going to model this beta t over here as a function of HT. So if we do more social distancing, it's going to slow down the rate of spread. Social distancing itself depends on the rate of infection. So this is really the idea that, like, as sort of, I don't know, governments try to gradually open economies, like in Europe now, for instance, that's happening. They're very closely watching sort of the new infections, and if new infections would spike up again, social distancing measures are being put in place again, or lockdowns or things like that. And so this is going to give us a fixed point in terms of the policy, depending again on the properties of the particular pandemic. Okay, so then in terms of the asset pricing, so there's going to be phase number one, which are normal times. So this part is very standard and boring. So you're going to have that, effectively think of it as like a Black-Scholes economy. So there's going to be log dividends that are following a geometric Brownian motion. There's going to be a stochastic discount factor. There's constant risk prices, lambda n over here, that are used to price these cash flow shocks. So what this model implies is that the term structure of expected returns of dividends is flat across maturities. Okay, so then the interesting new part is what happens during a recession and the potential for the financial crisis. So from time 0 to time 1, the economy escalates into or falls into a recession, and the cost or the impact of social distancing on cash flows is going to operate through this process phi t over here. And so as we get new data on like unemployment claims, on GDP and other measures of economic activity, we're going to learn about sort of like the cost of social distancing. And so there's going to be shocks over here. Investors learn about those, and those shocks are going to be priced, and the price of that one is lambda phi. Okay, and so we think that in general it's interesting to sort of try to fit these kinds of models in the sense that we can learn about sort of the social cost or the economic cost of social distancing and how investors price those shocks. Then the last part is the third phase, where there's a possibility that the recession is going to escalate into a financial crisis. And so when that happens, then dividends, they fall from time 0 to like the recession. They will bounce back, but they may not bounce back all the way to where they were before the pandemic. So there's going to be a permanent shock to the level of dividends. The depth of that one is controlled by this parameter psi. Now, what is the probability of that disaster? Think of it as that we roll through this recession, and as we learn about the cost of social distancing, that probability of a disaster is going to move around. So if we learn that social distancing is more costly to the economy, so if we see that the current recession is going to be deeper, then it's more likely that it's going to trigger losses on part of the financial system, and it's going to trigger a financial crisis. Okay, so that's how shocks to the cost of social distancing is going to feed into the disaster probability. In addition, there can be shocks to government policies, and that can mitigate the cost of this disaster. So government policy is not going to do anything to dividends during the financial crisis or during the recession. All it's going to do is impact the probability of a disaster. Okay, and so that's what's going to happen over here. Again, the disaster shock is priced. Obviously, if the recession escalates into a full-on financial crisis, that's going to be a high marginal utility state. And so there's another stochastic discount factor that prices the disaster shock itself. Okay, and so 3 phases: normal times, recession, potential for a disaster, and then we go back to a normal model. But if a financial disaster, financial crisis happened, then dividends start at a lower level compared to where they were before the financial crisis. Okay, so we sort of like have some initial results on a calibration, and again, this is preliminary, but it's a standard affine model, so we can solve for all the prices in closed form. And so the way it's going to work is that pre-crisis, these are the dividend futures prices across different maturities. Then we get the onset of the crisis, where there's a large impact on long-term prices, because now suddenly the possibility of this financial crisis is on the table that wasn't there before. A smaller shock to short-term prices. We then get that there's a shock that we'll learn that the economic costs of social distancing are larger. And you see that both the short-term and the long-term prices, they fall once again. And then during the fiscal stimulus period, we see that there's a government policy shock that's going to mitigate the possibility that this escalates into a financial crisis. See that the short end barely moves, but the long end then sort of like swings up, just like we saw in the data. And so the idea here is that we can sort of use these different events to sort of like uncover the structural shocks that may have been driving asset prices, and then we can learn about some of these more structural parameters and get a view on more structural view on growth expectations by maturity. So I'm almost out of time, so let me conclude. So what we do is we're summarizing the facts about the dynamics of stock markets and dividend futures prices. We use dividend futures to estimate dividend and growth expectations, and also to provide a lower bound. And then we give a simple model to just interpret some of these facts in a somewhat more structural way, and we think that can serve the broader purpose of figuring out the economic cost of social distancing as perceived by markets, as well as get another more structural approach to uncovering actual growth expectations not contaminated by risk premium. So if you want to sort of like follow updates of these estimates, then on Niels's website, we'll try to update them regularly, and you can follow them over there. Thank you for attending.
All right, thanks a lot, Ralph. So now let's jump into the Q&A. And in fact, because we got a number of questions very repeatedly, I'm gonna first ask on behalf of all the people who ask these questions, 2 questions from Ralph, and then I'm gonna move on and switch to participants to actually let them ask. So the first question, which was from a number of people, for instance, Kenneth Iron and Ludwiko Zaraga or Andragend, is basically asking about who are the people who are investing in dividend strips and whether the characteristics of these specific investors matter for prices.
Okay, so I think it's a great question. So I think there's been some discussion on that, and to what extent there's like market segmentation, and the investors in dividend futures markets are different from those that invest in the stock market. So I think the definitive answer to that is actually not something that we know. Like obviously these dividend futures markets involves many specialized investors, and so without sort of detailed data on actual holdings, it's hard to sort of know like who is where and how influential they are for prices. Now, the one thing that, of course, if you think that these markets are somewhat segmented, that may introduce sort of like some independent variation in discount rates in dividend futures markets that are different from equity markets. But that in and of itself would be interesting to explore and to sort of see to what extent there's independent variation across these markets, like we do in many other areas of asset pricing, where we try to understand whether the drivers of risk premia in credit markets or government bond markets or equity markets, whether those are like one and the same, or whether those are different. I think those are interesting and valid questions, and no different here than in any other market. Now, the thing that I do want to point out is that even though there may be some other factors that drive these discount rates in the different markets, these prices do forecast growth really well, and better than other asset prices. And so it's the closest thing we think that we have to actual growth expectations. And so despite these other factors that may play a role, we still think it's an interesting market to look at, in addition to the other markets we typically study.
Okay, perfect. So let me ask the second question. And the second question is whether you can basically elaborate a little on liquidity. For instance, Dmitry Muraev or Patrick Augustin suggested providing bounds on your estimates as a function of bid-ask spreads. And if you could elaborate whether that's possible or...
Okay, that's an interesting question. So bounds, I don't quite like. It's an interesting idea. I haven't thought about it. I'd probably answer yes, actually. So let me just go back to sharing my screen and just go back to that slide into like what happened to liquidity. So so the movements in prices are like very large, and so they're like way larger. If you look at the bid-ask spreads over here, the movements in prices are much larger than what you see in bid-ask spreads. So that part in and of itself is going to be a relatively small effect on the estimates that we have. In terms of like how liquidity develops during this period, you see that actually, as measured, I don't know, different people have different views on how to measure liquidity. At least volume sort of like spikes during this period in this market, and actually reached like an all-time high. And the same is true for sort of the open interest in terms of these contracts. So it's not that this market completely froze and that no one is trading in this market and that these prices are very stale. So there's lots of volume in a given day. These are sort of the bid-ask spreads. So you can sort of adjust these prices and think that if the price dropped from like $120 before the crisis to something like that or like $100 before the crisis to something like $70 or $60 right now, then the bid-ask spread of like 10 cents over here is not going to make any difference. And so we can surely, I think it's an interesting or a good idea to provide bounds based on the bid-ask spread on these estimates, but they will be tight.
Okay, perfect. So let me actually turn to attendees to ask you some questions. So let me start by Roxana Miheb. So Roxana, can you please go ahead and ask your question? You should be unmuted.
Hi, you showed the graph looking at the expected recovery during the current rare event versus the 2008 financial crisis, and it looks like today the expectations is that the recovery now is going to be V-shaped, but in 2008 it was an L-shaped recovery. So my question is, what's different in the belief formation process of investors that make these two rare events have such different expected recovery shapes? And is it a good idea to compare the current crisis with the 2008 crisis when they're not similar? So maybe it's better to compare this crisis with a rare event like the Fukushima crisis. Yeah. That's it. Thank you.
Okay, so this is the graph I think you're referring to. So thank you for that question. So for Europe it looks quite different. For the US it looks quite similar actually. I think at the long end even. We can definitely compare it to the Japanese crisis. We have the data there, and we looked at that in an earlier paper. So we can surely add that one to as another comparison. In terms of like what investors think, of course, that's hard to know. The part I don't know. So I think like for the US it looks to us looks kind of very similar. Slightly different for Europe, where there's a sharper recovery. I think adding the other event would be interesting to do as another observation. And actually, another event that may be interesting to add for Europe would be the European sovereign debt crisis. So those are probably the largest downturns that we have during this sample. Thank you.
Okay, great. So before moving to the next question, let me just remind all the attendees, guys, if you have a question, please raise your hands, because then all the panelists would know that you have a question, and then we can call on you. And now, Kenneth Aaron, would you mind please asking the next question, and you should be unmuted.
Okay, sure. So I had a question about the model that you had at the very end. It seems like, as far as I could tell, the model shows the effect of the virus only through the pause on the economy, the social distancing imposed by the government that then leads to a recession. It wasn't clear what the effect of the virus would be without social distancing. Is it the case that there's no effect in your model, or is there an effect on the model based solely on more people getting infected and dying from the virus without social distancing?
So there's no direct effect at this point. I think it's a good question you're asking. So there's no direct effect, but you want to think of like HT as a social distancing, sort of like inclusive of what people would do themselves. And so to the extent that people themselves would sort of social distance, even if the government doesn't impose it, just because they're careful. So that would also impact economic activity here. So if everyone just would sort of like completely ignore it, then you're right to say that in the current specification, there will be no impact on cash flows. But that seems like potentially something that we want to think about. I think is a great point.
All right.
If I can add to that, like Martin Eichenbaum from Northwestern and co-authors, they have a recent paper that's called Macroeconomics of Endemics, where they actually explore sort of what's the economic consequences of just having people, not just, but the fact that people, if there's no social distancing, so what you will see is exactly what Kenneth is referring to here, that people will die and therefore not work, or be sick and therefore not work. And then they also explore what happens as you add social distancing and more. And what they find is that actually, so the economic consequences of the disease in itself without any social distancing is quite limited. So most of the action is coming from the fact that you have social distancing. So consistent with what we are doing here.
Okay, Ralph, if you don't want to add to that, so let's move to Andrea Eisfeld. Andrea, can you please ask the next question? You should be unmuted.
Oh, thank you. I had put in the chat, I was just wondering, Ralph, how you're thinking about repurchases. I was wondering whether that might be driving some of the differences between the wedge between GDP and dividends in good times versus bad times, and also what other effects repurchases might have on the informativeness of dividend strips.
Right. No, so that's I think it's a great question. So I think ideally what we would like to have, if we could have perfect data, is we would have futures on cash dividends, on repurchases, on sales, on profits, and ideally even GDP. And so I think it would be interesting to have that data as well. And the one thing that we know is that during bad times, at least, so I think you're right to say that during good times, again, you see sort of independent variation between dividends and repurchases. But during bad times, like all of these series, like profits, GDP, cash dividends, and repurchases, that all of them sort of tend to collapse. And so I think during good times, if one would be interested in sort of understanding sort of like the pricing of repurchases and how that I think is sort of in good times, that would be more of a disconnect between the two. During bad times, less so. And so given the fact that all we have, which we already think is interesting, is all we have are prices on cash dividends. That's all that we can do. And so what I do think is it would be interesting is to figure out more carefully the mapping between dividends and GDP, potentially accounting for repurchases and all kinds of other things that may be sort of in the middle that we can model more carefully. So now we have a relatively simple sort of mapping from dividends to GDP, and potentially accounting for repurchases and some other factors. One may be able to do a better job and get more accurate forecasts of GDP growth. So I think it's definitely something worth like considering more carefully. But that's sort of like all we can say, I think, at this point.
Thanks.
Okay, perfect. So Andrew Powell, can you ask the next question? And you should be unmuted.
Hi, yeah. Well, first of all, thanks so much for your presentation. This is Andy Powell. I'm in the research department at the IDB. Two quick questions, if I may. First, I'm assuming you're using the aggregate dividend futures, right? But this crisis is probably different to previous ones in the sense that, you know, which sectors are really suffering much more than others, and maybe even a couple are gaining. So I was just wondering if you could speak to that. Maybe you did at the beginning. I actually missed the beginning. So if you did, I apologize. Secondly, I was just wondering about the model. I mean, the parameterizations of these models are really difficult because there's lots we don't know. And it seems that, you know, changing some of the parameters is pretty critical. I was just wondering where in the future, whether it might be possible to even try and back out some of the parameters of the model from market estimates. Particularly what I'm thinking of is the number of cases, which of course is probably likely underestimated, but at least, you know, the general principle using data that you have available to back out any of the parameters from the model.
Yeah, so I think both are great questions. So let me do them in reverse. So I really like your idea in terms of like, and we're thinking about exactly that. So that to see like what is kind of like model that we can write down, so we can map it back into something, into structural parameters that would be of broader interest. And so I surely think it's a reasonable sort of approach to introduce uncertainty in some of these key parameters. and see what we can then still identify from asset pricing data about how markets price sort of at the same time sort of the cost of social distancing with the dynamics of the pandemic. And because you can also imagine like other factors there showing up, like the likelihood of developing a vaccine, other treatments in the meantime, and things like that. And so the whole spirit of this of the model, where we're trying to go with the model, is indeed to sort of have a mapping from asset prices to sort of like broader parameters we could be interested in, and sort of and your suggestion to sort of think about whether we can actually get back to the structural parameters of these models could be interesting. But at the same time, it seems that if we're interested about the pandemic itself, using direct data on cases and things like that seems a more direct approach. But how markets price it would be quite interesting. And so there is some work where people argue that once you learn and update about these parameters, markets do seem to move. So I think it's definitely sort of an interesting direction to explore. About your question about different sectors that get hit differentially, I think it's interesting and it's important. And one sector that's actually sort of close to some other work that I'm very interested in is on insurance markets, which actually surprisingly sort of like did very poorly during this period. And so understanding like how different sectors are being impacted, and perhaps sometimes surprisingly. I think is an interesting area to go. Now, in terms of like what can you say based on dividend futures on that, I think it's a bit more limited. If you look at the single name dividend futures contracts during this period, then there should be an arbitrage relationship that holds that if you add up the price of the individual dividend futures, they should add up back up to the market, and there's quite a big gap. So in normal times, this gap is quite small, but during this particular period, there's really big gaps, and so the single name dividend futures market is not particularly liquid, and so if you look at the different sectors and how those dividend prices get adjusted, then just as a matter of ranking, they make sense where some sectors are hit more than others. But in order to really use it in the same way as what we're doing here, where we really want to see how different events are priced, I would be a bit more reluctant, simply because I'm not sure that these prices are at this point very representative. Or like one of the earlier questions about like, well, how large are bid-ask spreads? Can you bound it? And I think the bounds that you would get on that calculation would be very wide. Thank you.
Great. Thank you.
All right, Dennis Hamilton, can you please ask your question, and you should be unmuted.
Hi. Yeah, so I was just curious about how you think about the role of bankruptcy risk and like the firms within the S&P 500, their survival. I saw at the end with the model, you start looking at the financial crisis implications. And then similar to what Andy said, I was kind of curious if you could dig into that with some single name, variation. But it sounds like maybe there's constraints there.
Yeah, so I think it's a good question. So based on what you're suggesting, you could even imagine an extension of the following type, where instead of using single name dividend futures, you would actually at the same time also try to match data from credit markets. So if you want to really get at sort of like corporate defaults, and think about sort of like there's more direct ways of measuring cost of financial crises, then potentially you want to bring in data from those markets as well, and ask the model to also simultaneously like try to match those observations. So I think that's an interesting direction to go. We haven't done that or even like thought much about that, but it seems like a very reasonable approach to take.
Yeah, thanks.
Okay, perfect. Geoffrey Zhang, can you please ask the next question, and you should be unmuted.
Thank you, Miriam, and thanks, Ralph, for the seminar. My question was about the gap between sort of the informed insiders and uninformed market participants, especially given we see relatively flat market responses while the coronavirus is happening in China, but not in the US, despite the fact that insiders seem to know about this from these insider trading news we see now. So how do you think about that lack of response in market news in January and February? Thank you.
Yeah, in the beginning of the period? No, so I think that part is interesting. I don't think I have a great answer for like why markets don't move, or even like why they move initially just in the stock market and not in the futures market. So it really seems that markets were relatively seemingly slow to adjust. I think there's a much broader question in terms of like why markets move and so on. And there's some some other work in terms of like trying to trace this back to particular investors. So I think there's a sort of a recent literature that tries to use sort of demand system and look at holdings data and try to trace it back to price movement. So you sort of try to trace back price movements to like how different investors sort of change their portfolios and things like that. And I think that particular sort of like approach is extremely sort of interesting in this particular environment, where you can really try to understand like why certain sectors may move or certain or the market as a whole may move, and you trace it back to changes in investors' demand from whatever you may think of as being informed investors, like maybe smarter capital like hedge funds, versus like slower capital like insurance companies perhaps, or pension funds, and try to trace back like why did markets move or not move during the beginning it didn't move, but then who was then sort of like who updated and revised their beliefs during the later period. I think that would be one approach to make progress on that, to sort of see like which groups at least didn't respond initially but then did respond afterwards and were kind of slow. So I think that would be an interesting exercise to get closer to whose beliefs we're measuring, why prices move and things like that. So that's sort of my view on how we can make progress on these, I know, seemingly puzzling price patterns.
Perfect. So Amir Danesh, do you like to ask your question next? And you should be unmuted.
Okay, thank you, Maria. If you could go back to the 30th slide, please. You may have this, but I missed it.
Could you repeat like which slide?
Yeah, this slide. About the timeline. I was wondering if you could add a possible, like a second, like after the timeline is one, when because house experts have been talking about the possibility that there's going to be a second surge, a second peak, I guess, of cases. Is that something that you have in the model or you thought about?
Yeah, so I think your question is like to what extent we can add like sort of like uncertainty about like whether the virus is going to come back if we release some of the social distancing measures. Is that right?
Yeah.
Yeah, so I think that goes back. So I think that's an interesting thought and very reasonable one. So I think the way I would think about that is that we want to add uncertainty about the effectiveness of social distancing, or like if we let go of some of these measures. And then there's uncertainty about the rate of transmission. So it's really uncertainty about that data that one could introduce, or the mapping from sort of like how sort of social distancing measures are then being implemented. So I think it's interesting to introduce uncertainty there and see whether we can somehow uncover that back in the asset pricing data. So I think in general, just as a broad theme, like from what I get from some of the questions, is that uncertainty in terms of some of the model parameters on the pandemic side. It will be interesting to sort of introduce that and see to what extent we can identify some of those movements in prices and trace them back to what we can learn about the pandemic model. So I think that's an interesting sort of like line of thought. I think it's very reasonable and something we should probably explore. Thank you.
Thank you.
All right, now we're gonna ask the last question, and Rahul Sang Chauhan. I'm sorry if I mispronounced your last name. If you could ask your question, and you should be unmuted.
Thank you for the presentation. I was just curious about how the dividends futures factored in the monetary stimulus by the Fed as well as the ECB, because it seems that that didn't feature as much as the fiscal stimulus later on in the presentation.
Sorry, I didn't really get your question. Niels, did you hear it? Or?
No, I'm not sure. Maybe the sound is not, yeah.
Yeah, so the sound breaks up a little bit. Would you be able to repeat your question?
Yes. I was curious to know how did the dividend futures price in the monetary stimulus by the Fed and the ECB in March itself, and how that would have affected the growth expectations.
Okay. So we haven't looked at that particular date, like we haven't sort of like singled out, but we can surely try to do that. And again, I think it will be interesting in that context to do it also alongside some of the other markets that are very directly impacted by those measures, like corporate bond markets, government bond markets. So I think it's interesting to sort of like separate fiscal and monetary policy and see whether we can say something interesting about the dynamics around those events as well.
Okay, thanks everyone for coming, and thanks Ralph for the amazing talk and discussion, and we're looking forward to seeing you all next week at the same time to hear Hanno Lastik from Stanford GSV.
Thank you everyone. Thank you for organizing this.